Hi guys, in our presentation, we will break down Stellantis' plan to expand its production of plug-in hybrid electric vehicles, PHEVs, in China. As a global leader in the automobile industry, Stellantis is leveraging this initiative to support its sustainability goals while tapping into the rapidly growing EV market in the region. Through the use of accounting techniques such as capital budgeting and absorption costing, Stellantis evaluates the long-term profitability and impact of this investment. The expansion is designed to reduce carbon emissions, increase market share, and capitalize on China's advanced EV infrastructure and renewable energy incentives. Our presentation will explore how these strategies align with Stellantis' goal and sets the stage for its success in this competitive market.
Stellantis' cost control strategy is a key strength, enabling the position of affordable EVs like the Citroën C3, which target middle-class buyers and leverage partnerships in China to reduce costs further. However, a significant weakness lies in the profitability challenges of EVs, as lower margins compared to traditional vehicles make competitive pricing for middle-income consumers a persistent concern. Stellantis' joint venture with Leapmotor highlights a major opportunity to expand in China and other markets, reducing EV production costs while leveraging partnerships to drive growth. However, intensifying competition in the EV space from established players like Tesla and Chinese manufacturers presents a significant threat, pressuring Stellantis to maintain profitability and market share in an increasingly crowded space. These visualizations provide crucial insights into the PHEV market landscape in China, helping us understand the key drivers and growth opportunities that align with Stellantis' strategic journey for expansion in the region. Let's begin with the first chart on the left. This pie chart highlights the projected PHEV market share in China for 2024, with BYD leading the market at over 40%, followed by Geely, Li Auto, and others. This dominance reflects BYD's innovative technology and competitive pricing in the market. Moving to the center, the clustered bar chart showcases PHEV market share alongside charging station density across key regions. The Greater Bay Area leads in both metrics, underscoring its advanced infrastructure, while rural regions lag behind, presenting a potential growth opportunity, also allowing for Stellantis to make investment decisions. Finally, on the right, the stacked bar chart visualizes the steady year-over-year growth of PHEV sales from 2018 to 2024. The sharp increase in recent years highlights rising consumer demand, government support, and advancements in PHEV technology, reinforcing the upward trajectory of this market.
Stellantis aims to expand its EV, including PHEV, market share in China, but entering the market requires a substantial investment in production facilities or partnerships. The key challenges include determining the viability and profitability of the investment while addressing long-term sustainability goals. Stellantis must ensure that its investment supports profitability, aligns with its goal of reducing carbon emissions, and secures a competitive foothold in the growing EV market. To successfully enter the Chinese EV market, we propose using capital budgeting techniques to evaluate the feasibility and profitability of establishing PHEV production facilities. This involves analyzing cash flows and using tools like net present value, internal rate of return, and payback period. Profitability projections. Forecasting cash inflows from PHEV sales ensures a clear understanding of returns. NPV confirms long-term profitability, while IRR ensures returns exceed the company's cost of capital. Sustainability impact. Investing in green technologies will reduce carbon emissions, support compliance with China's environmental regulation, and lower operational costs over time. Market expansion and longevity. Localizing production and sourcing strengthens Stellantis' position in the Chinese EV market, reduces per unit cost, and secures long-term competitiveness. In summary, capital budgeting aligns profitability, sustainability, and strategic growth for Stellantis' expansion into China.
In this analysis, we evaluate the financial viability of Stellantis' potential PHEV manufacturing plant in China. Starting with the NPV, the positive value of 37.19 million indicates that the project will add financial value and is likely to be profitable. However, the IRR at 5.86% is close to the discount rate of 5%, suggesting marginal profitability. Moving on to the payback period, we estimate that the initial investment of $881 million will be recovered in approximately 7.4 years, aligning with standard industry benchmarks for such projects. The breakdown of costs includes critical factors like the $800 million for the production facilities and the annual R&D costs of $81 million, which are dedicated to establishing and optimizing the manufacturing operations at this plant. Finally, the sensitivity analysis provides insights into how changes in key variables such as the discount rate will impact the financial income, helping us assess potential risks in this investment. This analysis outlines the key non-financial management implications of establishing a PHEV manufacturing plant in China for Stellantis. In terms of market access and localization, the plant would allow Stellantis to better understand consumer preferences, integrate more closely with the supply chain, and enhance brand positioning within the growing Chinese automotive market. On the technological and operational growth front, the plant will facilitate technological integration, attract top talent, and enable the transfer of global knowledge, boosting innovation and operational efficiency. Finally, addressing geopolitical and cultural challenges, this move would reduce geopolitical risks, ease cultural adaptation, and provide opportunities for strategic partnerships with local companies and government bodies, further solidifying Stellantis' position in China. doing a sensitivity analysis, we were able to check the NPV of the analysis by changing the discounted cash flows. So when we change the discount rate lower than 5%, all those values are positive, and then at 6%, they started to get negative. But with a higher cash flow, these two at 128 and 138 million are positive NPVs. So it is pretty evident to see through the sensitivity analysis that most discount rates would provide a positive NPV for Stellantis.
Thank you, Rajith. Now we will be implementing Technique 2 to focus on determining an effective pricing strategy. The goal is to ensure profitability while maintaining competitiveness in China's highly cost-sensitive market. Key challenges include producing the optimal volume to meet demand without overproducing and finding a balance between an affordable and profitable price. To address this problem, we use absorption costing. This method ensures all costs, variable and fixed, are accounted for in a unit price, providing a comprehensive baseline for pricing decisions. The estimates for variable manufacturing costs are derived from relevant industry facts. Labor costs and production capacity assumptions use data from comparable EV factories and average rates in China. Component costs, such as batteries and hybrid engines, reflect ranges of market data for hybrid vehicle repairments. The total variable manufacturing cost per unit is estimated to be $17,500. Now, let's move on to fixed manufacturing overhead. While producing more helps spread fixed costs over a larger volume and improving profit margins, our management team have the following considerations. Firstly, excess inventory ties up capital and increases storage costs. Secondly, high inventory levels can misrepresent profitability by deferring fixed costs to future periods and raises issues in fair financial reporting. Thirdly, producing more than required can distort sales forecasts, which is especially vulnerable to Stellantis navigating its first entry into the Chinese market. Our production volume estimation of 39,000 units provides a safe buffer for meeting the demand while controlling costs. The fixed manufacturing overhead per unit is calculated to be $1,924. This is calculated by spreading the $75 million across 39,000 units. Thus, the total manufacturing cost per unit is $19,423, which forms the baseline for setting the price.
Moving on to CVP analysis for Stellantis. Potential sales value and revenue. In 2023, China sold approximately 2.75 million PHEVs. The market is projected to grow at a rate of 12.83 from 2024 to 2029, reaching an estimated 3.9 million units by 2029. Stellantis aims to capture 1% of this market, which is around 38,782 units annually by 2025. This is a conservative goal compared to Tesla's 8.4% market share in its initial years. Our pricing strategy is set at $25,000 per unit, competitive against the Toyota and Honda. Based on that, annual revenue is estimated at $969 million. With variable cost per unit of $17,500 as calculated before, this yields a contribution margin of $7,500 per unit, or 30% for CM ratio. Now let's break down their fixed cost. Their fixed cost includes $550 million for R&D. This is 10% of Stellantis global R&D spending in 2023. As they're entering into a new market expense are estimated at $97 million, based on a 10% allocation of projected revenue. Lastly, admin and depreciation costs total $150 million. Therefore, total fixed costs are projected at $797 million. Using this data, Stellantis break-even analysis can be made. Its break-even point is around 109,000 units, equating to $2.73 billion in revenue. For target profit sales unit, we aim to achieve a modest 5% profit margin after taxes and a 13% VAT. Stellantis would need to sell around 111,000 units, generating $2.8 billion in revenue.
I'm Christina, and I'll be introducing the balanced non-financial analysis. For impact on customers, investing in PHEV market in China would help Stellantis open up the East Asian market, which would expand the customer base more global-wide with a stable market presence. Nowadays, consumers tend to seek for more environmentally friendly vehicles to reduce carbon release and apply resources more efficiently. PHEV would be a good choice, as the demand is still growing and the industry is not saturated yet with several leading brands. For impact on market competitiveness, previously Stellantis has invested in China twice but failed. A common factor of these two failures is that Stellantis has not established its strong brand recognition in Chinese market. It can use social media like TikTok and Weibo to advertise its multinational elements. Celebrity endorsement would be a good choice too. Chinese market is very sensitive on price. Stellantis has a budgeted selling price for Stellantis cheap SUV would be around 180K, which is outstanding in price comparing to 220K to 270K for a BYD SUV. As a result of merger between French Peugeot, Citroën, and other groups, and the Italian-American Fiat Chrysler automobiles, it inherited over a century of automotive manufacturing experience, making its technology reliable. Talking about regulatory and policy considerations, Chinese government offers strong policy support on plug-in hybrid electric vehicles, which attracts more consumers to choose PHEVs when buying a new car. By driving up the demand, this policy enlarges the economies of scale. Meanwhile, Chinese government sets strict criteria for battery range and emission. Fortunately, Stellantis PHEVs meet both criteria. Now, I will also introduce the environmental implication of Stellantis. Stellantis' environmental strategy focuses on investing in the Chinese PHEV market and implementing competitive pricing with CVP analysis. By promoting low-emission PHEVs, Stellantis supports Chinese decarbonization efforts, reducing carbon emissions. Investment in production facility allows for integration renewable energy, lowering the environmental impact of manufacturing. Additionally, precise demand forecasting avoids overproduction and waste, while competitive pricing makes PHEVs more affordable, encouraging a faster transition from internal combustion engine vehicles to PHEVs, driving a cleaner automotive future.
In conclusion, Stellantis' strategic focus on expanding PHEV production to China is a critical step forward in advancing its sustainability goals, strengthening global presence, and delivering long-term financial value and security. Through the use of the capital budgeting and absorption costing tools alongside secondary managerial accounting tools such as break-even analysis, this initiative is deemed to be both impactful and profitable for Stellantis. Continuing operations in China allows for Stellantis to drive the market in one of the world's most dynamic markets. Thank you for listening to our presentation.